Thank you very much for being here and listening to this talk. This talk is about a book that is coming out in 6 weeks. It's a long book. It has 350 pages. And well, this is today deemed a long book, right? In the past, this would be just a normal book. So it's a normal book in these times, which is deemed long. It's the outcome of 10 years of work because what I will present to you is my habilitation. And it's based on a wager that I took 10 years ago, which was, let me try to understand how the financial crisis has actually changed financial regulation. If nothing had happened, I wouldn't have really written a book, because there would have been nothing to report. So you can already see how this research design almost binds me logically into the position that something has happened, which is what I will argue today. And yet at the same time, I'll seek to argue in a nuanced way that I'll try to show you where changes really did happen and where it didn't happen and why. And so this is linked to me. So the book is called Taming the Cycles of Finance, ? Central Banks in the Macro-prudential Shift in Post-Crisis Financial Regulation. And macro-prudential regulation, for those of you who don't know it, is the claim that we have to take into account the system as a whole, and so much so simple, but not only that. Actually, it's the claim that we have to analyze the behavior of financial markets and the behavior of banking institutions together. And only by analyzing them together can we understand the risks that accumulate in an endogenous manner. And I think the emphasis has to be on endogenous. So these risks are not coming from outside of the world. These are not asteroids hitting planet Earth, but these are risks that are building up in the financial system over time as actors take a lot of risk, more and more and more risk. If you're familiar with Minsky's work, he's one of those exponents of what is the financial cycle. And the task now is that central banks have been given the task after 2008. Hey, Paulus. Hi. They have been given the task after 2008 to look after the financial system, so to speak. And this book is about how far ahead they got in this task. Initially, it was done in 2020 when I defended my habilitation. And then something happened, which all of you will probably remember. It's called the COVID crisis. But not all of you may know that the COVID crisis also brought with it the massive intervention by central banks to the tune of trillions of dollars. And so I had to include this in my book, which I did. And not only that, as I was doing this, I actually realized, as I was pushing it into the present, I realized that I also have to push it back into the past. Yeah. So a book that was initially about the 2008 crisis became a book about a thought collective, what I call the Macro-prudential thought collective, that was worried about these risks from the 1980s onwards. And I was lucky enough to base myself on conferences that I found on the internet and this excellent book by Charles Goodhart. So I'm not making claims, 2011 book on the Basel Committee, which if you have read it, you will know that it's actually a treasure trove of archival material. Half of the book is actually archives there for you to work with. So he hasn't really fully analyzed them, but he has given them to you. So I use this, and then what I do is I have done 80 interviews with central bankers around the world, in particular the Bank of England, the Federal Reserve, and the ECB, but also the Bundesbank, the Banque de France, and so on, trying to understand how they went about implementing macroprudential policy after the financial crisis. And then I studied, and that was really, maybe one could call it boring, but I will try to explain why it was at the same time frustrating and interesting, all these financial stability reports that have been written from 2008 onwards. And the frustration that I felt with the actors that I was following was this frustration of being able to see risks, but not being able to act, which is what we're gonna get to, okay? Now, basically, when I started, the literature was already out there, right? Because as you may know, academia has become extremely quick in passing judgment and writing books. And this is by the way, but to be honest and fair, this is a really excellent book by Eric Kaliner from 2014. And it does have a question mark, the status quo crisis, in which he really asks, and he himself thinks, that there was no significant change in regulation of finance post-crisis. And a really good argument that was done in a book chapter by Daniel Mögel was, well, you know why there was no change? Because actually there was nothing that was coherent, no economic idea set that was coherent that could challenge the neoliberal way that financial regulation was set up. And I think he really had a point there. And what I want to argue today is that this challenging idea set does exist today, and yet it faces real difficulties in making it into the very core of central banking. Yeah, so it is there, it is integrated, but in the words of Juliet Johnston, central bankers have built a room in addition to all the rooms that they already had. So macro-prudential regulation becomes one additional element of central banking, but it doesn't manage to get into the core. And if I have time, I'll try to get into why that is the case, okay? And at that point in time, Geoffrey Underhill, another excellent researcher on financial markets, identified macro-prudential regulation as the only real challenger, okay, to this pre-crisis view. And there it says, well, you need a systemic view on the financial system, and you have two goals. This is important, two goals. On the one hand, it's to increase the resilience of the financial system. So in other words, you make a bigger dike, yeah, the bigger thing that holds off the walls to make sure that the system can stand. And at the same time, you're supposed to tame financial cycles. That is to say, you're supposed to limit what some people have called irrational exuberance in the upswing in order to be able to deal with the downswing. So lower the amplitude, yeah? And this indeed was a fundamental challenge, and I base myself on other researchers here to make this argument, because if you look, what's the different, so many people have argued that the efficient market hypothesis has been an important element for the regulation of financial markets in general, and even of banks, okay, which of course only to a certain degree, but if you're interested in this, for example, Leonard Seabrook and Elin Singu have written great work on how this entered banking regulation. And in this view of the world, finance follows a random walk. Capital allocation is optimal when markets are fully disclosing all information, because markets have this capacity to best process risks, okay? And so in this worldview, there is no problem in integrating private risk management into public risk management, because private risk management is optimal. Making it so became the task of public regulators. We know, based on very good work, that this by no means meant that the state was absent. So I'm not saying the state was absent before the financial crisis, evidently, but the banking regulators sought to educate the bankers to become the perfect risk processors they wanted them to be, okay? So if you read the work by Céline Baud or by Kevin Young, you know that they were really pushing. They were really unhappy. They were looking what the bankers were doing, and they were telling them, that's not our idealized private risk management system. Can you please step up? Can you please become better? Yes, but they were not having their own top-down assessment of risks. And this is the big change, okay? And so, whereas in the efficient market hypothesis, you really want to be rules-based, limited interventions, really no surprises from financial market actors, is completely different from macro-prudential vision, okay? In the macro-prudential vision, finance is cyclical, which is not a big surprise. I mean, I don't know, it's a problem when you work too long on a thing, right? For me, this is not a big surprise, right? So for me, finance is cyclical, but so for them, finance is cyclical. And so there is misallocation of capital due to manias, which is one reason why the state should intervene. And that gives epistemic authority to the regulators and to the state officials, not only to the markets. And so they need, you know, policy devices for seeing and knowing these risks, which scan the financial system as a whole, and they need to intervene. In the words of one could call him cheerleader of macro-prudential regulation, they need to become the systemic regulators, the systemic risk managers, I apologize, the risk managers of the financial system as a whole. This is their task, Okay, and that's a really fundamental, almost that is an orthogonal view, and we can get more into why this is orthogonal to what happened before the crisis. Now, when we look at the literature, they say, was the macro-prudential regulation a paradigm shift? Common answer is no. Why? Because it's seen as emasculated. In other words, it started as a tiger and it ended as a fur. And I think the real problem here is that my colleagues, and that's where I want to push them a bit, they're too dismissive because they're operating on a binary logic, and they're operating on a too narrow field of study. These are the two contentions of my book, basically. The first one is they're basically just thinking yes, no. Yeah, it's either a paradigm shift or it's not a paradigm shift. And then most of the time, evidently, you end up with it's not. And they only look at policy. Instead, what I want to do is I want to take the infrastructure of a paradigm shift seriously. And I want to investigate what is called fragmented change. So I think that there has been a lot of development in different dimensions, because in this framework, you can think of different dimensions of an overall paradigm where it shifts at several different speeds at different points in time. And so I want to highlight these different dimensions, which to me are, on the one hand, the economic dimension that is very much including. So I'll get to that. This is Peter Hall. So I'm basing myself on Peter Hall's excellent, I think, framework from 1989, where he distinguishes when he asks what's the power, where does the power, the political power of economic ideas comes from, and where is it actually realized? He says it's realized in economics, in the bureaucratic field, and in the political field. And I want to do a full disclosure here. When you read Hall, you will realize that when he says economics, he means two things. He means both economics as a science, and he means the economy. And I will focus on economics. But of course, the economy, in other words, the question, can macro-prudential policy be implemented in a political economy that relies on finance for growth? Yeah, is very important. And I just wasn't able to integrate it easily in my framework. That doesn't mean that it shouldn't be done. It's a shortcoming that I would like to lay out for you to improve upon my work, okay? So it's economics, the bureaucratic field, in other words, how have central banks changed, and the political field. In other words, do these policy tools actually get used, and how do they get used? And I combine this with a science and technological studies approach to the construction of risk objects. So my argument is, in order to intervene on the cyclical risks of finance, you first have to construct the cyclical risks of finance. And what I found in my study is that economics was pretty much, mainstream economics was of no help in this regard. Why was it of no help? Well, if you look at the whole development of macroeconomics and the DSGE models, rational representative agents, and so on, the endogenous buildup of financial risk is an impossibility, because forward-looking rational agents, it makes no sense. Like, if they look forward and they understand that there's a bubble, they should take action to eliminate that bubble, okay? So this is macro, but even in micro, there wasn't much going on. But, and this is very important to me, it's exactly in the last 15 years that this economic risk object is constructed. So this is, to me, where the biggest change has happened. Today in economics, I can say finance is cyclical, and I'm not getting laughed out of the room, and I'm not getting banned from academia, which would have been the case 20 years ago. Okay, it was a very heterodox point of view 20 years ago, and today it's no longer. And I'll walk you also through the other fields. Now, these are the questions that I ask. Of course, is it in the interest of politicians to pursue the topic? And in how far are politicians actually involved in these policies? Is it accepted in the economic profession? And is the administration actually capable of implementing these economic ideas? And we will see, in a sense, you can think of this, the results that I will show you is the strongest change in economics. The economic viability of these proposals is really high today. The administrative viability is mixed. In particular, well, actually, the best it will be in England, in the UK, sorry, in the Bank of England. The ECB and the Fed face real problems in implementing these ideas, but they will try to find ways of implementing them, in particular through stress tests, because stress tests are outside of the realm of politics. Okay, and for politics, you will find that when politicians are involved, we really see little to no action on finance. This is not to be completely negative about this, but this is the finding that I have. So the materialization of ideas. When you look at this, the literature tells us you have to focus on the production of new policy devices that allow regulators to know, see, and regulate systemic risks. These regulators, they had to operationalize this new approach. And so they had to generate the data, identify the metrics, and the trigger points. And this is essentially the work of 15 years. And this is the work that I'm following in this book. To give you a very early exposure, and I will get back to this in 20 minutes, but this is a very early exposure. This is 2012, and this is the idea of the financial cycle. What they have done here is they have thought to use certain measurements of financial exuberance in order to plot the blue line from the 1970s to 2011. And what you can see, which is rather very interesting, the financial cycle seems to be a historical phenomenon. So up until 1981, there is not much of a financial cycle. So it's not really swinging that hard. But with deregulation in the US, with the growth of finance, with the epoch of what we call financialization, the financial cycle seems to be increasing in time. And the claim, of course, because this is written by applied economists for central bankers. Yeah, it's basically, the idea is, if only we had intervened in 2004, 2005. You can see this here, right? Because that's when the risk, the blue line, that's when the risk really was building up. So the idea is, if you can see and know systemic risk, you can intervene ex ante. And the whole challenge of these last 15 years was to generate metrics that allow you to look into, if I may say so, into the future, which what we all know as academics we should never do. But these guys have to, because they're supposed to tell their policymaker, you really have to do something about it because finance is getting out of control. Back at the time, I had an interview, somebody from the IMF called this, unfortunately, Mickey Mouse economics. Okay, so in the profession, this is still, at this point in time, it's noticed, but not accepted. It's not yet up to the standards of economics. Okay, and so yeah, I'm going to give you this historical and comparative approach, as I already told you. This slide should go somewhere else because it doesn't fit with my narrative now. But you will hear about the UK, the EU, and the Fed, and you will learn that banking is rather successful. The regulation of banking is rather successful. And if you challenge me on this because of the banking crisis in 2023, don't, because I have an answer. But shadow banking is really a problem, as is housing. So shadow banking and housing is really where the problems are. So I did not 80, but 77 interviews, oops. But what I also did was topic modeling and statistical analysis of 44,400 papers. And there's a forthcoming paper where we extend this analysis to 70,000 papers, where we show that really macro finance, which is the equivalent to what I've been talking about in terms of economics, has been established from 2013 onwards in mainstream academia. And it's really driven, and that's the most interesting result that we have in the study, it's really driven by central bankers. So 1/3 of the authors that publish on macro finance are central bankers. So this is really applied economists that make a difference to economics itself. Now, the history of the macro-prudential thought collective. I'll be rather short here, but I think it's important. This group is institutionalized, to me, at the transnational level with the establishment of the Euro currency standing group. And the Euro currency standing group, which will be later renamed as the Committee for the Global Financial System in 1999, is worrying about financial innovations since the breakdown of Bretton Woods, starting with the Eurodollar market. And here already we have the problematique fully displayed. Why? What's the problematique? The problematique is financial markets and banks are increasingly engaging with each other, becoming codependent, and that poses risks on a macro level. You see, this is, of course, problematic because central banks usually don't have jurisdictions over financial markets. This is more the realm of actors like the SEC. Financial economics is not up to the task either. And what really happens, and this is where Charles Goodhart's book comes in superbly, is the Basel Committee for Banking Supervision, which is the other committee at the Bank for International Settlement, is growing and is like kind, I hope, with Abel. Is it kind? So they're not killing them, but they're really holding them down. Whenever the Macro-prudential thought collective wants to say something, the Basel Committee tells them to shut up. And the Basel Committee, these are the guys who say, if we look at one bank at a time and every bank is stable, then the financial system is stable, right? This is the micro approach to regulation. And this really, what Goodhart really shows beautifully is how the Basel Committee repeatedly goes to people like Lamfalussy, who's the first head of the Euro Currency Standing Group, and says, guys, you can't just say whatever you want because people will think this is our position. Either you coordinate with us or you shut up. And they increasingly gain the jurisdiction over this. So the committee, this is marginalized, okay? Now, the next thing, and then I was really proud because this is something you cannot plan. I found they nevertheless write plenty of papers, right? And so these papers are, to quote, an interesting a collection of data without theory. They're just like, oh, look, all this kind of stuff is happening. This looks dangerous, but they have no theory whatsoever. And given this fact, in 1993, they will suggest to all central banks, to the important central banks on this planet, to make research conferences. And this is, in 1995, the first conference takes place. There are 4 of these kinds that I can trace. The first one takes place at the Fed in 1995. The second one at the Bank of Japan. The third one at the Bank for International Settlement, and the fourth one at the ECB. And what is really nice about it is you can really trace how the thought collective gets empowered through financial instability. Okay, so in 1995, you have Greenspan who gives the first speech and was like, yeah, we should care about systemic risk still, but it's very much the logic of how do we empower finance? How do we make more finance? At the same time that he knows that he will have to give a backstop to finance. This is what he calls systemic risk at the moment, okay? And then in 1997, however, the East Asian crisis happens. And so when they meet again, I think they meet actually in 1998, this is a fact of life that these guys cannot just deny. And so you have very beautiful contradictions between academic economists and applied economists at this conference, where these applied economists say, guys, you know, there's just been a tornado going through this region. We cannot act as if tornadoes don't exist, right? And the academic economists say, you shall not speak of tornadoes if you do not have a model of tornadoes. Because if you have no model of tornadoes, they don't exist. Okay, and it's really what I'm lucky with is that they have summarized the debates, so you can read these debates, and that's just luck, you know, like pure luck. And so in 2002, we get, after the dot-com bust, we get to the Bank for International Settlement, and you see how these guys are trying to grapple with what's happened also in the dot-com bubble, and how they're increasingly using academic allies. So Yun Song Shin, whom you may know, is at this conference, and he's cited. So Yun Song Shin is an outstanding mathematical economist who is today the chief economist of the Bank for International Settlement, but before was at Princeton, okay? And before that at LSE. And Charles Goodhart and the group of the LSE is a very important ally, and we can get into that if you want. I'm be curious to hear your insights on this. But basically what we can observe is that there is a nascent epistemic community which develops different concepts, where the financial cycle is really one idea among many, but it's not that prominent. Yeah, much more prominent are concepts such as contagion, herding, so short-term concepts, like what happens in financial markets. And so what I show in chapter 4 is basically this is basically premature, not yet ready to be accepted by the mainstream, but it's out there. And this is how we go into the financial crisis. And so in chapter 4, I trace how the thought collective is, it's really interesting. First, it's really central to the initial framing of the crisis as systemic. The really strong, they are basically writing, the Financial Stability Forum is writing the framing to me. Yeah, now this is a claim, we can debate this, but there are these interaction effects, there's this acceleration because financial markets and banks interact and so on, which is also how they measure to insert themselves in the discussions on bank regulation. And I trace how the countercyclical capital buffer, which is really the only real macroprudential tool on the global level, is inserted in Basel III. At the same time, what is fascinating to me is that they fail miserably in the discussion of regulation of shadow banking. So they have the analysis, they have the claim, they have the this is dangerous, we need to fix this, and basically everybody goes against them. The market regulators, you have no idea, we don't know what you're talking about. The accounting regulators, we don't know what you're talking about. You're not going to touch this. This is not going to happen. Forget about it. Okay? So there is, in a sense, limited success and then a lot of delegation. What basically happens is the G20 says, let's do macroprudential regulation as an answer to the financial crisis. And then they say, dear central banks of the world, please figure it out for you. Homework for the next 10 years. And so from chapter 5 onwards, I go on and I trace how this happens, okay? And so the countercyclical capital buffer is the only real success in the financial crisis time. It enters at the last possible point, and I can really show it's really, I mean, this is really tedious work, but you can see in the first drafts of Basel III, the countercyclical capital buffer is not determined. They're basically saying, we don't know yet. We don't know yet how we'll do it. Because in the end, it becomes a discretionary way. It's a discretionary, the regulator gets the right to raise capital standards if he thinks there is a bubble. Okay, and that was initially very contested. In my interviews, the people said something like, the more theoretically inclined of us wanted to give it to the market. Because if you're more theoretically inclined, evidently, you're believing in the market, at least at this point in time. So you wanted to somehow find a way to say, I will raise capital when the market wants me to raise capital. But that's evidently in contradiction to the whole idea of macro-pro, right? Because markets can be trusted. So in the end, somehow they make it. And this, what is fascinating about this is they have no idea how to really do it. So they have written something based on political pressure. We have to show the world that we're serious, but they don't know how they will do it, okay? And so shadow banking completely fails. Beautiful interview with a guy from the Financial Stability Board who tells me the arguments were in their infancy. These were beautiful arguments, but there was no research. So if there's no research and you're living in an era of evidence-based politics or policy, they didn't accept it. I mean, of course, yeah, go ahead. Yeah, sure.
Spain had these countercyclical buffers even before the euro started, because we saw that the credit growth was 15% for 10 years, and we knew they were running to bubble. It was then stopped because the government said, you know, we levied these countercyclical capital buffers. Oh, I see. We levy these countercyclical capital buffers, but it all means that the Spanish banks lose business, while the Germans, the French, the other banks still lend into our boom. And this countercyclical, the Basel one, was a real breakthrough in the sense of across jurisdictions, you can claim, ask other banks not to lend into your credit market.
Yeah.
Did that Spanish experience not play any role?
Oh yes, it did. So yeah, that's a very good point. The Spanish experience is repeatedly cited as an inspiration for the capital buffer. There is also, I think, Thiemann, who's an economist at the Bank for International Settlement, is a member of this working group, and so he manages to push his argument. But for me, it's interesting that in the interviews that I had, the people who would consider themselves serious economists would not take that serious. So it's based on the way that it came out in the end in the interviews to me is that it's based on the conviction by these people that they have to do something different. It is not based on the conviction that this is the right, you see what I mean? Like that this is already done. Like it's something in, it's a risk object in the making, if you want. It's something, there is something there, but especially the Americans, they distrust it. They really distrust it. And the Americans really wanted a market-based measure. And the only reason why we didn't get a market-based measure is because you don't have market data for developing countries. And Basel III was supposed to apply around the globe. And so then the guy said, we can't do market-based. So what do we do now? And that's where Thiemann came around and said, look, I have these results, and I think we can manage the cycle a bit. And this is actually in the interviews, the US economists to me told me that they were surprised later that it actually really worked. So this is kind of where we are in 2008, but it's a great question, and I'll try to integrate that a little bit later. Now, the domestic implementation, which is chapter 5, for me is really interesting because we have to make a difference between, I think, discourse and action. So when you look at the discourse, you'll think that the US is the least macro-prudential. They've done nothing. Like, right, they will always say, right, what is this cycle? It doesn't really exist, and we don't really know whether it exists, and so on. But if you look at what they do, not what they say, but what they do, they're really, really, really harsh, especially with their banks. So Tarulio, who's the guy responsible for the banks and installed by Obama in 2009, he's basically using the stress tests to push up the core capital of US banks in a way that has never been pushed up before, against any kind of political resistance, because stress tests are opaque. You know, and initially, so the banks will complain and the banks will get their way under Trump, right? In 2018, 19, they'll get their way. But until, you know, under Obama, they don't manage to, it's also very hard to explain to people what's actually going on, right? So the stress tests come around and say, you need to raise your capital, and they comply. And that's interesting. And we find that also in the other countries, but not in the Eurozone, but in the UK. Now in the UK, so in the US, it's a style that is very much based on academic economics and then on the stress test. In the UK, we have more of deliberation. And here it's really, again, I'm lucky. There's a researcher in a guy called Don Cohn, who was first working at the Fed, and then in his old age goes to the UK and becomes a member of the Financial Stability Board. And he gives these wonderful speeches where he says, I'm really surprised what we can do in the UK. I think it would never be possible in the US. And if you read Sheila Jazanov, she speaks of civic epistemologies, and she says the UK is characterized by this gentlemanly style of deliberation until you get to a common conclusion, commonly held, and then you can impose it. And that's pretty much what Don Cohn describes. So they basically use economics, but they don't use it as the thing that holds them back. So if they are convinced they are in a cycle, upward swing, they'll do something about it. And they do. And the Eurozone, well, the Eurozone really wants to. It's the most, so the ECB is the most gung-ho, sorry if I may use this word, about macro-prudential regulation, about anti-cyclical, but they have no tools. The tools are at the national level. So it's basically you have the European Central Bank saying, there is a problem, there's a problem. Yeah, please do something, Germany, or please do something, France. And then France needs to be convinced, and Germany needs to be convinced. And I have a paper out on how this works out, but it doesn't really work out that well, to be fully honest about this. Now, what I do then is basically I show, as we are at this point, what the economists are doing. And the central bank economists, with and without academics, are amassing and analyzing large-scale data sets to generate these early warning systems, then to seek to condense them into a simple number. And I want to, basically in these interviews, it's called actionable knowledge. We want to produce actionable knowledge. So we want to be able to say to the policymaker, you need to act now based on this one number. So it has to be simple, right? It has to be very simple. You can't like go on like for 10 minutes. No, it has to be, in this case, the growth at risk number is 5. You have to act like this really simple thing. And so you can trace how they have done it. And I say in the language of STS, they make the data speak. Yeah. So they spend millions and millions of euros on making these databases, and then basically they rerun model worlds over the last 60 years of history in order to predict the crisis. So you use past data in order to run it as if it were the future. And so they developed this thing, and this is the updated version of this cycle that you saw earlier. Okay, it's the growth at risk framework, which is a stylized fact. Basically, this is fascinating. It's really just one stylized fact, which is when there is an upswing in financial conditions, there is a high likelihood of a downswing in GDP. In other words, a financial crisis. But this is asymmetric. So this is to say, this improved financial conditions do not predict more economic growth in the future. They only predict less economic growth in the future. What is interesting about it is three things. First, there is no causality in this paper. So they have some ideas why this could be, but there's no model in this paper. Why is that interesting? Because it's actually published in the American Economic Review. So it's a paper that, you see, the normal academic economic paper is a paper that has a model, that has some causality and so on. This is a paper that just establishes a stylized fact. And it was built as actionable knowledge. So when I interviewed some of the people who built this model, the guy said, look, this is for the Federal Open Market Committee. When I want to go in there, I want to be able to say, the likelihood of a 5% tail risk has gone up by 20%, or the likelihood of a real financial crisis has gone up by 20%, something like that. That's the idea, okay? And so they have implemented this mostly hidden, yeah? And they make it work for banks. And that's why banks, I think, are today, that's the first change, they're really safer, okay? Now, shadow banking, and I have to hurry up a bit because I don't have so much time, I think, but shadow banking is a whole different story. I mean, shadow banking, basically the way that shadow banking is the way how financial markets and banks interact, okay? And it's this interaction that keeps worrying these guys for 40 years, okay? But they have no jurisdiction over financial markets. They only have jurisdiction over banks, okay? And so what happens is you have all these great ideas. Bruno Meyer and Pedersen, Adrian and Shin really changed the way that we see financial markets, but it's really difficult to find agreement across jurisdictions and across regulators. The SEC, the lawyers at the SEC, initially they say, what is systemic risk? And when they say that, they mean like, can you please give me a legal definition of systemic risk? So you have to translate economic thinking into legal language. And then you have to make them feel comfortable with it. So that took 10 years. So today the SEC is comfortable with systemic risk, but back then, really no way. So what happens is all the real tools that they try to develop, this anti-cyclical margining of repos, which today again is discussed, by the way, is so ridiculously low that the Fed itself will impose higher standards than the global standards. And the Fed is not really, but the Fed is like, this is ridiculous. Like, basically, they make a regulation that wouldn't have been constraining in 2008. So they're like, this is nothing in the sense. And so what happens is there's a last-minute intervention by US regulators in 2014, which is really behind closed doors. And it's really a ruse. It's really a ruse of last-minute adjustments. So these guys are concerned. They don't ask anybody. They don't ask the banks. They don't ask other regulators. It's basically the US, which in the last minute will say, we will make the business of banks in shadow banking more costly. Boom, done. And everybody's like, where does this come from? This makes no sense. This is like, but this again, for me, is important because the US is acting while it's not talking. Yeah? So officially, they are not big, but unofficially, they're really convinced and they try to do stuff. The effects are, in a sense, contradictory. What happens is, and this is maybe the thing that I want, like the current situation is best described like this. So they collect the data, they know the risks, they have essentially weakened the capacity of these banks to act in shadow banking in these markets, but they still have a system that is based on shadow banking. So when problems arise, instead of these broker-dealers providing liquidity, today central banks provide the liquidity. So central banks are the market makers of last resort. And so whenever there's a problem, central banks will give liquidity and will bail out the system, okay? Because they understand the risks and they want to prevent the downswing and the pro-cyclical features of the shadow banking system. And that's what I call in the last chapter of the book, the unhappy consciousness of central bankers. They basically have completely understood the risks of the financial system, but they can't change it. So imagine I would tell you that this house is really highly inflammable, okay? And I would say whenever there is the slightest fire, we immediately will have to flood this entire thing and everything will disappear on the walls because we have to flood everything with water immediately. Okay. Unfortunately, I have no permission to take out the stuff that makes this house so highly inflammable. So I can't reconstruct the house and I can't forbid people to come in smoking. So the only thing that I can do is stand there with a water hose and be like, if there is the slightest fire, I will be like, and that's the current situation. So, and the interesting part to me is that this increased economic knowledge about the financial cycle, what it does is it doesn't lead to anticipated action that says, oh, there's an upswing, we really need to act, but it leads to very quick and robust action in the downswing. It's like, oh, this is dangerous. This system can really go down. So we have to stop it from going down. And that's what I call basically is the asymmetric implementation of macro-prudential policy. It really does a lot in the downswing, and it really doesn't do a lot in the upswing. And that's what you can see, where you can see that that's my COVID is to me essentially the confirmation of this, what they themselves call themselves firefighters. Yeah. So when I say this, when I use this metaphor, it's not me, it's Bernanke, it's Timothy Geithner, it's Paulson, it's all these people. They're like, we are firefighters. We have to stop this, we have to stop the fire. And here you go. So the Federal Reserve, which is on the right, okay, in March 2020, explodes its balance sheet and adds in 1 week as much as it added in the entire global financial crisis. Okay, so you can't, this is not, I should put numbers here and not this, but so it goes basically from 2% of GDP to 12% of GDP of the United States of America in 2 months. In 2 months. Okay, and it does that because it has understood, and this is basically the scandal of the COVID crisis, if you want, and we have exchanged on this, and it's increasingly confirmed. If you see what the regulators are doing when we talk about this on Friday, it's basically the hedge funds, they're huge. The hedge funds have taken certain very simple bets, but with a lot of money, bets that are supposed to be not risky at all. COVID happens, COVID suddenly shifts the entire system, and suddenly these guys face huge margin calls. So they have to stomp up cash to the banks that lend them the money, okay? And they can't, so they start selling. As they start selling, the entire financial system starts to become very wobbly, okay? Everything starts to be like, and so the Fed receives these phone calls and engineers a bailout of these hedge funds. Why? Not because they like the hedge funds. So I want to be clear on this. It's not because they're friends with the hedge funds. It's because they understand that if these hedge funds fail, the banks who have lent them all the money will also fail. And if these banks fail, then everything fails. So again, they are firefighters. And what they do is they will buy up hundreds of billions of euros of assets, dollars in this case, sorry, hundreds of billions of dollars of assets from these broker dealers that have lent the money to these hedge funds. Yeah, and nobody discusses it because this happened during COVID. Everybody's busy with something else, you know. And this is, in a sense, the tragic situation where I end in the book is, if you do this, if you act in an anticipatory manner in the downswing, you will never get the political power to change the system. So I call this a bad equilibrium. You're really caught in a very bad equilibrium because you stop the fire, but nobody will ever give you the permission to reconstruct the building. Now, I may be, we'll discuss this on Friday. I may be shown that I'm wrong by history because the US is just trying to do it. But I think there's this distinction between, no problem. Thank you for being here. There's this distinction between front stage and backstage action of central banks. This is the backstage action of central banks. There's not many people have talked about this. And there's this nice paper that says, if you do not speak about it in the time that you do these interventions, later it's too late. Because nobody has understood what happened, right? So if you they go out now and say, this is why we want to regulate the financial system, because we learned during COVID, the treasury market in the US is not stable, the hedge funds take big bets, it's really a problem. But you have to face hedge funds. Yeah, they're not easy to, okay. So to come to a conclusion, and I took 45 minutes, and I apologize for that. The macro-prudential thought collective has established the idea of the cycle both in academia and in central bank discourse. So this is really a change. And I've published a paper last year in Economy and Society where I really trace this. And you can see how these Chicago economists are really unhappy. Chicago University economists are like, what is this? Why does everybody believe this exists? This doesn't exist. But still, it seems to exist. And it has been implemented in these policy devices, which signal the buildup of risks. But the problem is that the action on these signals is generally weak. Strongest for banking and weakest for shadow banking. And so this is what I meant earlier. Yeah, you read these financial stability reports, and it reads like the IPCC. Same thing, yeah. So temperatures keep going up. We should do something. Temperatures keep going up. We should do something. Financial stability risks keep going up. We should do something. And nobody, or there's really not much that is done in the end, okay? So what happens in the end then is that financial stability concerns are today established as a valid mandate of CBs, but it comes to justify interventions in the downswing, but not the upswing. And so for me, this is in a sense a perversion, you could argue, of the idea. Because the initial idea was, guys, we have to do something before it happens. And today it's used to justify that you do something when the kid is about to fall into the well, to use a German expression. Thank you very much.
Okay, thanks a lot, Matthias, for the very rich presentation, which I think will lead to a very rich discussion, also because the room is full of economists, not always the case in our EGPD seminar series. So we don't have so we don't have much time. So yeah, without further ado, let's go straight to the Q&A. Who wants to break the ice? Can you use the microphone because we are recording? So thanks.
Okay. Do I need to lean in or whatever? So really interesting paper, and you cover many of the topics that I've been also dealing with in the last few years. So hugely interesting for me, but I'm sure also for the wider community of people interested in political economy of finance. You sort of mentioned at one point that there's a strong political demand for this, and that central bankers are in some sense empowered to come up with a package of reforms, and I guess that takes place in a combination of national central banks and also at Basel and the SFF/SFB and so on. But then at the same time, you sort of say, okay, well, central bankers are coming up with all of these concepts and building out this entire intellectual agenda, but they are constrained in how far they can achieve that. So in one sense, you're sort of saying, okay, well, the power is offered in this kind of principal agent style relationship to central bankers, but then at the same time, they are limited in what they can actually achieve. And the limitations there seem to be from the intellectual community. So you sort of say that economists were looking for some kind of causal story. They were looking for more evidence to be able to justify an intervention within markets, this kind of thing. But I wonder if equally there are some political limitations at work as well. And also, how would we know which is the kind of more important aspect to that? Because I think it makes a difference as to whether these central bankers just lacked the power for a whole scale paradigm shift or regime shift, or whether they didn't have the intellectual wherewithal or the kind of credence to be able to build this within the community itself. And then there's the whole point about stress tests. It seems to be that they do have, in the stress test case, that the reason these have become so pervasive and so important as a way of kind of measuring risk is because these take place outside the political sphere. And that seems to be the political kind of limitations of what they were able to achieve. But all in all, such an interesting book, and I can't wait to read it.
This is a great common question. Common. Do you want me to react immediately, or yeah?
Yeah, we can react immediately to
Okay,
each
it's
question.
great. So because I mean, this is a very good point, and I wanna be clear on this. It's almost so power, the power that you're referring to. I think we can differentiate different elements of power. The first one is the political disinclination to act on these kind of warnings in the time of a boom. And I have studied this, and we have shown this to operate in the macro-prudential measures for housing booms in Europe. So we can show, based on the 17 countries that have experienced the housing boom until 2020, we show that every country where politicians have the final say, they do nothing. And where central banks have the final say, they do quite a lot. And then there's this thing in between, which is the Financial Stability Council, where the politicians and the central banks have to negotiate. And there they do a bit. So this is the first political element, which is really politicians not wanting to act on housing bubbles. The second element, evidently, is the capacity of these actors that you're seeking to constrain to sue you. And so in the book, I discussed this attempt by the Federal Reserve to impose one and only one official anti-cyclical measure in 2013 on collateralized loan obligations. This measure in 2017 is, so the banks immediately sue. And in 2017, the administration, the courts find that the Fed has overstepped their mandate, and that if they want to really regulate this, they need to go to Congress and ask for a law. And in 2017, Trump is in power, so it's dead. Yeah, but you can see there is a limit, and I mean this limit is not 100% identical with the intellectual community that opposes it, but you can also see that the firmer you can base yourself on academic arguments, the more you have at least one additional element on your side in this political struggle. So for me, the intellectual community is in a sense one of these roadblocks in the political struggle. So if you don't even have the intellectual community, then you have a real problem. Like then you're completely alone. And so what I found interesting in my interviews is they would even speak of allies in academia. They would say, we have allies in academia and we know them. And we invite these allies. We push these allies. And of course, these allies are Princeton professors and so on. So they're very, what I'm trying to say is it's even the intellectual community. So the economics itself is political. Not everything is political, but the economic science is political. To me, it's political because it justifies the state economy boundary. Like, where does the state have the legitimate right to intervene in our era? And here we can debate. Maybe I'm too idealistic. But to me, it's really crucially also shaped by economists. In a struggle, there are some economists that say yes, others that say no. That's fine. But you need to have at least some economists that say yes. And here's my name, and here's my reputation, and here's the cultural capital that I'm giving you to pursue these kind of policies. It's yeah. So how I would see it.
But it fits quite well. What I had made a note myself for what you reconstruct, and I mean it's your theoretical approach. Paul is quite pragmatic in how he says a paradigm shift comes around, right? You must have some economic theoretical support for it. The administration must be able to work with this new paradigm, and you must address a concern that politicians have. And this latter thing you actually show, they didn't have that concern. They didn't think particularly that this was of the essence. And it may have been a bit the ironic success of the central banks as firefighters. They did it quite well. Nothing happened until now with the inflation. And in a way, they had to construct this concern of politicians, and in a way, we're not fully successful in this. I mean, this is like welfare state reform and forever. You know, where also the experts, the technocrats, the advocates in elite bureaucracies try to push an agenda that actually the politicians are not fully signed up to. And that's then makes this always a bit of a fragile thing. Where I am, however, a bit less pessimistic, and this is maybe that the events do play a role, is that sudden explosion of inflation, right, with the cost of living crisis and so on, that if the macro-pru community manages to say, look, we cannot only use this in the downturn and just throw ever more liquidity at every problem there is, then we have this inflationary potential. I think this could work in their favor to also use it in the upturn.
I mean, this is, I will write this down and send this in downturn contribution to inflation. So this is in essence what I'm currently working on. This is the paper we're trying to write about the attempts of these macro-pru guys to enter into the core engine that is monetary policy. And what we find, at least until 2021, so the monetary policy review, is that they're taken seriously, but they don't have the same strength as the monetary policy advisors of old, so the DSGE modelers. And so what comes out in the end is financial stability considerations need to be taken into account in a qualitative fashion. So we kind of have to discuss it, and if we really think there's a problem, then maybe we should raise the interest rate in the short run in order to deal with something in the long run. And yet, at the same time, as we do the interviews, the policymakers, they want, you know, one economist told me from the Fed, he said, look, on the left-hand side of the equation is you raise the interest rates tomorrow with 0.5 percentage point, you have 100,000 more unemployed, or X thousand more unemployed. Certain, like certain as in like model certain. You raise 0.5 percentage point in order to fight an asset bubble effect. Maybe something happens. What happens? We don't know. How much happens? We don't know. And so as they are dealing with these trade-offs, the left-hand side of the equation says, we know for certain this is the negative output. The right-hand side, we don't know what's the positive effect. You know, and for me, at least right now, where I stand on this paper is, this means that it doesn't happen. I mean, they can say as much as they want about, we'll take this qualitatively into account and so on. When push comes to shove, and you have to make that decision. And I have to qualify this, however. This is where the paper is, it's always difficult to write paper, so you have to, this might work for balance sheet policies. So it doesn't work for interest rate policies. It can work for other tools in monetary policy that it's not. And so your suggestion, which is really a very super powerful suggestion, to say, if they manage to link QE And the QE, as I show in the book, yeah, QE, quantitative easing, becomes more and more about addressing financial instability. Initially, this is not the case. Yeah, initially they say we have a deflationary. But in 2020, when they do QE, they explicitly say one goal of this asset purchasing program is to counter financial stability risks. And so if they manage to link QE to inflation, yes, they will have a big win. My problem is, and this is also what I find in this other paper that will come out soon, is the macro finance guys, they exist in the field of economics, but they are dominated by the macro guys. And the macro guys are still the kind of, 3 equations, we shock the system, and there's a financial friction, but yeah. So there, I mean, and I'm maybe even looking either for a co-author or for an extended stay at some place where I can think really deeply about macroeconomics. But there is something really heavy going on that is also on the ideational basis why these guys, the macro guys, cannot integrate financial instability. That is nothing, that's not political in the simple term political. It's political in the sense of like assumptions that are crucial for modeling that are orthogonal to financial instability. So it's the politics of economics, if you want, or something like that. Yeah, but this is to follow. I mean, if you have seen a paper that makes this link between QE and inflation, that would be great. Just click on the, yeah, that thing.
Okay. So thank you for the presentation. You know that I find this work really fascinating. I've known it for a while, and that's one. One question about detail, maybe. So when you present the growing work on cycles of finance and on macro-prudential interventions, what are the internal debates and inconsistencies and so on that they have? You know what I mean? Because from a scientific point of view, I would be surprised if it was all that easy again in the end. You know what I mean?
Yeah.
So, for example, how do you conceptualize and measure cycles of finance, or what are different positions on this? I've tried to read the little text a little, and it was about credits and housing and so on, but there's a lot of conceptual and theoretical assumptions in all of this. Although globally it is very plausible, of course, to me, and I totally believe it. But then in the best case, if this theory would enter the mainstream, the next step would be that the debate would go on, the scientific debate would be about which parts of it hold, which aspects, to what degree, and so on, right? And not globally true or false and false.
Yeah, no, this is absolutely, it's a brilliant question. And so let me clarify a few things, and I agree with you on this. So I think the people who have been the most successful in pushing this agenda have been the people in the US. And that's not a big surprise if you know the field of economics, right? The intellectual field of economics is, sorry to the EUI, but it's still going to be Princeton and so on. And it's going to be the Federal Reserve of America, because they are also rather proud and important economists there. These guys have been how do you say when you refuse to answer whether God exists or not? Agnostic. They have been agnostic about the financial cycle. So when you read their models, it's absolute, to me, it's very fascinating, because it's their modeling strategy is to say the financial cycle may exist or may not exist. What does exist are these regularities that we're going to show you. You see what I mean? So they refuse to take a position on it. When you interview them, you understand. So this is but there's a certain inconsistency that I want to show you why there's an inconsistency. Or when you interview them, they're rather convinced that it does exist. Yeah. So it's not that they're ontologically agnostic. They are, I think, professionally agnostic, because as long as they stay professionally agnostic, they have a capability to be integrated into the mainstream. Because even people who say the financial cycle does not exist, they have to grapple with this stylized fact. So for me right now, what they have managed to do is stylized facts. And the important part is, in a sense, to say, what's the expertise of these people? What can they do and what can they not do? And what are they tasked to do and what are they not tasked to do? And so these guys in the central banks, they're applied economists. Adrian here that I cite that makes this graph, he's basically an econometrician. Okay, so he did a PhD in financial econometrics, I think even at the LSE or something, in MIT, but he was at the LSE before. And so, but this is basically somebody who can produce, who can work with large masses of data to establish stylized facts. So things that need a theory, but he's not paid to be a theorist, because that's not what the Fed wants him to do. He's a statistician. He works in the Fed on this kind of like, what should we do in 3 months? Yeah. So he's not paid to be a theorist. He doesn't have the time to be a theorist, and he's not a central member of the macro crowd, if you see what I mean. And so these people are capable of producing these stylized facts that ask for theories, but they're not pushing themselves theories because they're also not paid for it. And that's not their job. It's not their expertise. The people who do push for theories that I do see and that I find fascinating, but that's where I am right now. I need more time. There is one paper, it has the beautiful title, a DSGE model with the banking sector. Wow. You would think that every model of the economy should have a banking sector. And then you learn that DSGE models did not have a banking sector. But it's a DSGE model with a banking sector. It's by Brunnermeier and Sannikov, 2 Princeton economists, closely related to the central bank economy. So they are allies. If you read their paper, it stays a DSGE model. And as it stays a DSGE model is a dynamic stochastic general equilibrium model. That means the economy tends towards equilibrium. That's the fundamental assumption. It is always shocked, so it never is really in equilibrium. But if these shocks would stop, it would go to equilibrium. You see what I mean? Now, a financial cycle is the endogenous buildup towards this equilibrium. You see? So if I have a model that says the economy tends towards equilibrium, I can never integrate a financial cycle. That's a logical impossibility. If you read the paper, what they do is they introduce a second agent. So instead of having one representative agent, they have 2, and one is stupid and one is smart. One is quick and one is slow. And so they generate something that looks like a bubble, and then they say at the end of the paper, and yeah, they say, this looks like Minsky, doesn't it? So yeah.
I think it's not quite right. There may be people in the room who know that better, but an equilibrium can be a cyclical equilibrium, but it has no crash. I mean, you cannot have a crash. A kind of intergeneral dynamic model like this, the DS,
Yeah.
DGSC, whatever, will come back, goes up and down in this more or less regular fashion. You have the cyclical equilibrium. It's the problem that you say, Macro-prudential says, if you do not stop this build up, it can actually lead to a crash.
Yeah, thank you.
Therefore, the need for discretionary intervention is, I think, what militates against the normal.
Yeah, thank you. That's very helpful. That's what I meant earlier. I should have said I am also looking for a course on this, to not say stupid things that economists shouldn't say. And I'm not an economist, so but if you do not stop this build-up, you get a crash. And I think that's the essentially the question is, what's your position on finance? And the position on finance, as it has developed in the academic mainstream from the 1970s onwards, is that you can neglect finance because in the end, it doesn't lead to this crash. And it's only with this financial crisis that this professional conviction that is established by people like Robert Lucas, Thomas Sargent, and so on, that this conviction is questioned. And yet, and this is the absolute, some people have written about it, but I don't think that they have really captured the causal reasons for it. Yeah, so there are papers that say, like by people like Cornel Bahn and Otni Helgadotir, that say there have been some challenges to DSGE models, but nothing much has changed. I agree with that analysis, but the question is why? And so what I find is in the central banks, here's what I still want to work with is, so in my interviews, I can trace how 2010-11 is the absolute low point for DSGE models in central bank action, okay, at the ECB, only at the ECB. I don't know about the Fed, but I have an interview quote where somebody tells me that Trichet, at that time, the ECB president, gets up and says, if ever any one of you comes in here again with a representative agent DSGE model, I'm going to throw you out of the room. Okay? And he doesn't say it, he yells it, at least according to my interview. Okay? And the reason for that is because they keep telling him complete humbug. Okay? They come to him and they say, according to our model, either Italians suddenly have really developed a taste for staying home with their parents and being unemployed, option number one, or option number two, we have a technological innovation and shift, sudden technological innovation shift, which explains this large-scale unemployment. We only haven't found it. We don't know what it is, but according to our model, these are the two options that could explain what's going on in the Eurozone right now. Okay, so in a sense of the practical applicability, complete failure. Yeah. And then, but what do these macro-pru guys do that I find, which by the way are in a different tower? Even they're physically separated in Frankfurt, right tower, monetary policy analysis, left tower, macro-prudential analysis. What do? They build DSGE models with some possibility for default. That's their greatest achievement. So instead of challenging the DSGE model and saying we should get rid of it, they say, we are going to be your servants, or we are going to add something to your model. And that's, I think, a crucial element in the story that hasn't been told yet. It's this in the applied realm, where DSGE models get a lot of their power from the fact that its central banks are kind of using them in some kind of way. Yeah? So I'm not saying they slavishly follow them, but they use them. Okay, and it's in the central banks that these guys decide, we're going to, instead of toppling you, we're going to add a little bit. And that's where they stay, you know, they stay subordinate. They don't take over. But why? Maybe it's the logic of keeping going. If you don't have another model, you're like, we can't throw away the model even if it's shit, because if we throw it away, we have no model. And then we have to say that we're flying blind. And better to say we're flying not blind, even if the model, I mean, there's, you know, something, but happy to collaborate. This is a Civica visit, and I'm here to look for collaborators, as I'm told by my sponsors. Yeah.
Okay, do you have more questions from the room, or maybe follow-ups to previous comments? If not, then we can, yeah, okay, then we can close the seminar at this time. And yeah, so we reconvene again next week, not on a Wednesday because it's All Saints Day, so we reconvene the day before on Tuesday. We'll have our visiting fellow Federico Fabrini with another book presentation on EU fiscal capacity, legal integration after COVID-19 and the war in Ukraine. And thanks a lot again to the members of the audience today for the discussion, and to Matthias for the great presentation. I hope you enjoy the rest of your rather short stay at the EY and find co-authors and collaborators. Again, this is also part of the Civica project, so it's very good, and we're happy to have you.